Okay, we are going to try and go over as many markets as we can, but let's start with the Nifty because it went through a very complex pattern through the entire fall from December to March, and then we broke out of this falling channel. Now the complex pattern that we formed is what we'll call a W, X, Y, X, Z kind of structure. And at the end of the Z, I have this mental debate because what I've drawn here is triangular, but we can always think about whether it's 1 and 2. Now, why did I really move to this? Because the initial rally was not sure impulse, and also what has happened in say the Nifty 500 or the Nifty all cap, they've actually bottomed here and not over here like the Nifty. So we call that an orthodox bottom, where the entire market or broad market bottoms is that the starting point from where we should count, and then we take that as the orthodox low point. And the existence of a triangle means this may just be a basing pattern inside the Nifty from where things begin. So this was the sort of debate which helps us then decide how do we count from here and where do we complete things. So far what we've actually done is drawn a channel from this bottom where the triangle occurred and then tried to count from there on. And we've marked this as an initial first impulse which pulled back, took support on the breakout line, and now is going higher, and we're nicely moving inside this rising channel so far. So this has been the holdout for the entire rally. As and when this holdout breaks, then we have a different situation. But right now that's been the holdout. Now some people have asked me whether you can actually get into an ending structure over here. Now, if you do take an ending structure, you would have to start thinking of whether this is 1, 2, 3, 4 and 5. Now definitely there's a triangular structure here which can allow us to think about an ending pattern, but a confirmation of anything completing would only be when you actually break this channel. So this support is at around 18,317. We are trying to get there, but we haven't really broken anything, and therefore according to me it's too early to say. In fact, the midpoint intraday might just be the 20-day average. 18,347 is where it is. So we are watching this, we are trying to extend this move, and each sector index is slightly different in terms of the count. So if we look at Bank Nifty, it's been much stronger. The overall count is more like a first, second and third starting, and I've drawn a channel around it, so it doesn't have the same kind of channel as in Nifty, which is offering support. We've just drawn the first one because the count itself is different. Now when we go to the mid cap, we do see a channel from the bottom which has held here most recently, and again we've moved higher from there, and we are making a new high today in fact. So a lot of strength in the mid cap index, and if it's holding the channel, ideally should head back towards the top end of the channel. Now when you look at the small cap, we don't get the same kind of channel from the bottom. So again, I'm trying to draw a mid-range channel from somewhere here to this bottom, and then considering where it can go, and that can possibly go to the top end of this channel. So this is how different structures are, and in each of these cases right now the option is to either think that this is wave 1, 2, 3 going on. So is it 3, 4 and 5, in which case 3 would be shorter than 1, and if that is true, then 5 would probably be even smaller, just go up to the top end of the channel and stop. So why would it be smaller? For those of you who are not comfortable with the Elliott wave rules, the second guideline or rather rule in Elliott waves is that the third wave can never be the shortest. So in this case, if 3 is shorter than 1, you can't have the fifth wave that gets bigger, because then the third wave becomes the shortest, and then it's not 1, 2, 3, 4, 5. So then what would it be? Then it would mean that the third wave itself is extending. So that hasn't happened yet, but we can always consider that as well. So we have two options: either the 5 completes with a shorter fifth, or else we get a third extending, which means after 2, this is all part of 3, 1 of 3, 2 of 3, 3 of 3, 4 of 3, 5 of 3, and it'll go on. So when do we know which of the 2 it is? Actually, we don't know. We just have to keep trying and see till you get a reversal. Like say if the trend channel breaks, then yeah, we have to think that okay, maybe something has completed and now we need to mark it as 5 done. Or till that's not happened, we'll consider the potential of extending it as well. So we have to keep both things in mind and keep moving on from there. That's sort of how the judgment call is. And so the same thing even in the mid cap index. Do we really do a 1, 2, 3, or do we do 3, 1, 3, 2? And that's sort of, you saw that approach in the Nifty itself. We've marked it a series of 1, 2, 1, 2, meaning the third wave will probably extend. That's the presumption as of now. unless something breaks. Now we are getting close to expiration, so as we get closer to that, sometimes markets do tend to give a reaction. Like even this correction here occurred on the 17th, around the last part of the month. Sometimes markets pause because you're getting close to expiration, some profit booking kicks in. Now we haven't seen much of that, and if you asked me on Friday, there was no setup for that to happen. So that was the interesting thing. It's partly what we discussed in the weekend with Indiacharts. Now these intraday charts, the way I'm discussing, is what we do in our daily Nifty intraday update. So if this interests you, you should really subscribe to Indiacharts and start watching our midday videos that discuss the intraday chart setup, momentum across indices, sectors, and so on. So that's what we do, and what we saw here is that this was A, B, and C. It means a three-wave decline on Friday, and then it bounced back from that. So it was not impulsive. It held the channel line, both of which indicated that probably prices extend higher, and that's what we saw. Even though there was this election-related news, markets moved up yesterday because the setup was indicating that, and sort of this time we haven't seen that kind of profit booking into expiry week. What can end up happening though, as that didn't happen, is you can even get some slowdown consolidation, before it moves higher, just because of the effect of expiration. So what is that effect? Is essentially more related to stocks, because stock options go into delivery settle, and then which is next week, and so margins kick in by Friday, and that forces a lot of buyers to unwind a little bit or roll over or something, mostly unwind. Then there are stocks that go into ban due to excess position, and then they don't get traded, and so all of that causes some short-term volatility. So anyway, not seeing that on the charts this time. Last time we could at least see some divergences and wave one was ending. This time it is just showing slow and steady extension. So that slowness is probably got to do with being in this phase, but that it's extending higher means you can't really take a bearish view on the market, because there's no sign of a trend reversal. And the broad market is just on its own steam. Mid caps, like you see the mid cap index making a new high, we are essentially seeing the broad market doing pretty well. So that's an important takeaway. You simply move over and look at, so these are the major gainers on the Nifty 500. There are a lot of stocks that are really running up, and we can actually see that in the breadth as well. And we'll do that. We'll look at the advanced decline. Of course, the advanced decline for the day, you can see this group wise. So you have 33 advancing versus 17 declines at a Nifty level. And if you go slightly broader, if you go to the Nifty mid cap 100, you see 80 advances versus 18 declines. And if we actually move over to maybe the Nifty 100, it's 68 to 32. So pretty broad based. And if you go to the 500, it's 365 versus 131. So very broad based advance happening in the market, which is why you see a lot of major gainers out there. But even if we look at, say, we look at the breadth, okay, so we can simply go to the advanced decline, and let's take the 20-day, which is more shorter term in nature. So we actually see a divergence between breadth and Nifty. So you see from this point on, the AD ratio is slightly cooling off, but the market continues higher. Now usually in trending phases, that tends to be the case. In an up-down market, the breadth can pretty much peak with a peak in the market itself. But when you have a trending move, which is why I'm taking a slightly higher time frame so that I can actually show you. So give that a moment to load. Of course, for those who still not seen this, this is the strike platform that we're going to be making public in a while. And oh, sorry, that was the drawing mode, so it was actually not showing. I'm wondering why it was not showing that. So here now, when we are in drawing mode, so what I'm really looking at here is, see, you get certain spikes here, but sometimes as the breadth even declined to this point, market fell a bit and then simply continued higher. So this is usually during a strong market phase, till you really get a much broader divergence. You're really not done with a market rally. But in an up-down phase like this, you can actually, peak with the markets with a spike in the breadth indicator itself. But again, here when it is trending, you see a couple of divergences. So that's where we are. I think we are seeing the breadth decline and the market is still going higher. So somewhere usually late in the rally, you will see breadth divergences, or you'll see a secondary rally, which may be starting now if you're seeing that strong breadth where prices move up, and then you actually get a peak. Now till that point, you should also be able to count the entire rally in 5 waves. We have shown you that we are still doing 1-2, which means basically we're in the third, and the third is not over. Once the third is over, we'll get a fourth, then a fifth. So that can take quite some time. In other words, it can be quite some time before we have a completed 5-wave structure from where we get some retracement. You may get smaller pullbacks, but nothing great. So that is sort of what this helps you to really conclude. And in terms of the broader breadth, now this is the 40-day average. You actually see this breadth rising. So very, very different when you look at two different types of breadth indicators. The 40-day is still going higher, and it's nowhere close to getting to any kind of peak as yet. So that's where it is. This rally has legs and is relatively strong as far as the broad market participation is concerned. Now, one of the supports that we've really been getting for the market was from domestic institutional investors. And when I say that support essentially was coming from big long positions that they've been taking up whenever the markets hit a bottom. So we've drawn a red line out here. You can see this red dotted line, which shows long positions reaching a historical level, which is comparable. So we've seen that previous occasions, many of which were associated with the important bottoms, after which we saw multi-month advances. Now what has happened from there is the position is unwound down to zero, which means it's now neutral. So they've actually gone marginally negative, only 69 contracts short, which is actually almost nothing. But main point is that from having a lot of long 60,000-70,000 contracts, they've unwound to a neutral position. Now the last time it was neutral was somewhere here, from where it went up again. So the one option is, okay, if markets peak and they fall, then they go long again, and then that becomes the next bottom. But the alternate is in a trending phase, you'd find that a neutral position is not the end point. It simply continues till they've turned extremely bearish or reached a negative position, which is what we saw at this peak, and we saw that again at this peak. So two of these tops were associated with short positions. This was also a mid-range neutral position from the short side. So right now we are at neutral. It's a judgment point, but we are not just neutral on the DIs. We are also neutral on the FII index futures position, because if you look at the FI index futures position, also came back to zero, and it's just been fluctuating there for the last couple of days, plus or minus a few points. And so we are just here. Okay, so this is like at around what, minus 392. It's hardly short. So it's very, very marginal, and it's moved up a bit, up and down a bit within this range. So it's even gone positive for a few days, then negative, but clearly around the zero line, and we're trying to figure whether this continues upwards towards a bigger long position, or does it reverse. So in that sense, it's an inflection. But we always see at the end of this, when we're making a judgment along with sentiment has to also fit the wave structure. So we try to look at what the wave structure is telling us, and it's not really telling us that something is complete in terms of 5 waves. We have 1, 2, and we have 3 going on, and I'm trying to wait for 3 to continue, do a fourth and a fifth, because I'm expecting an impulse, which means I don't expect this data to stop here and probably continue higher till we complete the 5-wave impulse, and that's where it may be a more significant reading. So that's my sense of it. Unless something changes, right now nothing has happened to change that thought. Another interesting fact is that after a very, very long period of time, we are seeing consistent buying by FIAs. So you see all these greens here, or you see the greens here. However you really want to watch it, you're seeing a lot of fresh buying coming in, which makes it pretty interesting, because we've had a prolonged period of red. If you actually look back here, so there's a lot of red. It just stayed there. Every time it was green just for a week, but we just really didn't get a prolonged green period. We did get some green here in this first rally, but the amounts were small. Now we're actually seeing some meaningful amounts, 1,600, 1,500 crores per day, which then can actually add up to something. So that's going to change the flow. So at least there's a sentimental change as far as FII behavior is concerned, in this market. And it's an even bigger change if you compare a lot of the history back here in the October, post-October 2021 top. There was a lot of red, deep reds, a lot of selling happened back there. It definitely reduced in time, but we haven't gone back to a great green period yet. So that's something I hope lies ahead. So now we're looking at what a lot of the other markets are doing, specifically Asia. I think the best mover here has been Japan. I've also written about it before when it started to break out of this triangular pattern on the upside. So initially we were trying to think whether this triangular pattern is, part of the WXYZ. I was thinking it's, something like this, completing, and then I completed Z at this point. And from there, it's been trying to go up, first wave, second wave, and somewhere extending in its third. Still not past this previous high. Until that point of time, I think people will keep debating the idea whether Japan is out of the woods or not. But I think it is. In the big picture of things, Japan does spend a lot of time consolidating, like we see, back here. And so it's done similar here. And then once it starts to move from there, it makes a meaningful rally. So that's what is happening. I think it may be a third wave of some degree. You've done a first, second, and going into another third of higher degree if you really, go slightly longer term. So it's going to be a big impulse move over here again. Japan has become a performing market, breaking out from what was a multi-year deflationary bear market in Japan. So that was they've called it the lost decade or lost 2 decades for Japan for this entire phase from 1990 onwards, when its bubble popped, and then it went into this large phase down here. And from here it's actually rallying back. So this is 1, 2, 3, 4, 5, wave 1, wave 2, and my sense is 3 started, which means 1, 2, 3 going on. And within that, we actually marked this as 1 and 2. So first of the third, second of the third, and life should move forward. So this is what Japan is doing. It's really coming out of the woods. However, it's doing so because they tend to buy a lot of bonds, which stimulates their market economy or inflates it. They've been doing it pretty aggressively despite the recent inflationary cycle. And that's slowly getting them out of it. Remember, in the past, it never worked because whenever they tried to fight deflation back here, it failed. Now, after a long time, with some changes, it seems to finally be playing out. So that is the situation with Japan. Very, very different from what the rest of the world does. Now, China is back on its reopening trade. If you actually read the news, you'll hear about, now it's slowing down. Now, of course, the momentum can slow a bit, but that's how it has been, 2 steps forward, 1 step back. You had a big impulse, pull back. We didn't break this previous low, so it is still a wave 2. And then from there, I've been trying to think that this is 1, 2, 3, 4. This pretty much looks like an expanding triangle. So I can take 4 except that it has overlapped with this. And so because it has sort of an overlap, I'm not sure it's 1, 2, 3, 4, or I have to simply stick to 1, 2, 1, 2. Now I've marked ABC here because I was just trying to think whether it can be a corrective structure as well. But my primary thought is that we are slowly starting a third wave higher. Okay, so this consolidation should be complete since we touched the lower end and rebounded, and we should now slowly start a fresh move to higher highs as far as China is concerned. So that's where China is placed, and that ends up reflecting very much on Taiwan. Taiwan being pretty close to China has also an impulse, except that it's overlapping. We may think it's leading, so it's 1, 2, 3, 4, 5. Maybe it's not overlapping because otherwise I would have written over here that it's a leading diagonal. So I don't see me writing here. It's not overlapping. So it's a 5 wave in a situation where 3 is shorter than 1 and then 5 is the shortest, which is why I've taken 1 and 2 overall. Done. Correction looks very small, which can put you in doubt, but it need not, it can be. I mean, because we are looking at a much larger structure unfolding, then pullbacks can be meager and you can simply extend. The same thing here. Is this 2 here or here? That's something we figure out later. It can also be that this is 1 and then ABC 2, expanded flat 3. We'll look at those possibilities. I'll have to judge whether this can fit and expanded or not, looking at the internal Fibonacci ratios. Otherwise, we'll have to simply think that this entire structure is 2 and develops into something. But if you have China picking up, you'll probably also see Taiwan picking up. Some of the other markets, not so strong, though it looks like Singapore should have done its wave 1 and 2. We can see an ABC correction. But till you see that momentum going ahead a little more, you will not be sure because it looked the same way for Jakarta. But it has had multiple pullbacks. Every time it's tried to break out, like it tried to break out from this triangular zone, gave back everything. Here it looks like we have a clear 1, 2, 3, 4, 5. But it didn't start a third wave and then failed. Now, the only option in this failure is to think of this as an expanded flat where you make this a B. But C doesn't look like a clear 5 wave done. So is it 1, 2, 1, 2, 3, 4? Or what is going on? So is it going to take a couple of more legs before we can complete it? Pretty painful to see that. but that's how it is. Indonesia, which overall is actually a strong market because it didn't fall as much. But just like India struggled a lot in the same trading range, Indonesia still seems to be struggling. I would have thought it's out of the woods now, but doesn't really look like the case. The last thing I would really want to check on is the EEM and look at some of the other emerging markets. So, for example, Brazil is actually making a series of higher highs, although it's overlapping. So, we can't say 1, 2, 3, 4, 5. We'll have to say 1, 2, 1, 2, 3 and try and continue. But broadly, there was a 5-wave impulse from the 2020 lows. Okay, so this entire move here was 1, 2, 3, 4, 5. And then from there, we actually trying to, in fact, there may be 2 1-2s in here somewhere. So I've actually missed something, and then it's trying to consolidate from there WXY. I thought this was probably a 1 and a 2. It didn't break this low, but we haven't started a clear third yet. But we do have some initial momentum. So with that initial momentum, what we'll try to do is, think of the answer is, it would. So I can see that this is a leading diagonal right at the beginning. So we're trying to figure that out. This is a leading diagonal. Then it's probably wave 2 from here to here. 2 from here to here. And then it's like 3, 4, 5. So actually this is 1. And then this is 2, 3, 4, 5. That's how we would actually complete the impulse for Brazil. So it's sort of showing signs that, maybe finally after a double bottom here, we are picking up. We've already seen that happen in, say, places like Russia, which is where all the trouble was last year. The Russian market has started to slowly edge higher as if the crisis is coming to a close. And that then sends me back to the emerging market index, right? The EEM or MSCI emerging market index is what we've used to try and think whether the previous entire cycle is done. So you had this big move in the EEM, and we've retraced almost 80%. So I put 78 here. It's gone slightly below that as well. 78% retracement of the entire move, and which was 5 waves up. So this is the larger first wave. Okay. And then we have a second wave down. And now we are again doing a first and second. So now this first and second wave here is essentially got a 61% retracement inside it. Okay. So if you use the retracement tool, it's an exact 61% touch and go. The same can also be repeated from this bottom to this bottom is again another 61% touch and go. And so I would actually like to think of this as one of three, so a subdivision happening. So we have, one over here, and now we are probably doing 2. And this 2 also, whether it occurred here or should I shift it here, because this in between move, this correction, then it's 3 waves up. Then I think this low broke, if I'm not wrong, or it almost got back there. So it looks like it may have broken, or maybe it didn't. So let's look at the low point 38.48, and what is the low point here? 38.47, broken by a 0.01. But a break is a break. Now you can argue again, see here in all these cases, you can always argue that you have a situation of an expanded flat. So you can do 1, A, B, C, 2 and then start 3, or else you take the whole thing as 2 and then start 3 from here itself. Now which one is better can also be fit later on based on what happens later, So if it completes 5 here and you'll say, oh, well, this looks like 3. But if you take it from here, it looks like 5. Then we end up getting the best fit. So when you have 2 alternates, you don't know the answer, you figure it out later. The answer you do have, which is more important from a trend perspective and an investment perspective, is that the larger trend for emerging markets turned positive because it broke out past this trend line, falling trend line from the 2022-21 high. And that is an impulse where you've done wave 1, wave 2, 61%. And again, we are doing another 1, 2 and starting a 3. So this is sort of looking like a very good built up for a longer term uptrend that has started in the EEM index. So an EEM index is made up of, I think, some 1100 or 1200 global stocks from different countries. And since it includes stocks, it gives you a very, very different picture from looking across Asia. I thought maybe if Asia does in a certain way or China moves in a certain way, that weightage would have a direct impact on the index. But you never see that because it's made up of stocks, the big stocks of every country chosen, put together, like even an Infosys is in there. And that gives you a very, very broad idea of what the large caps across the world are doing among emerging markets. And therefore, the trend reading can be pretty interesting and, give you a good guidance in terms of what to expect across these markets. So it's not just me looking at a recovery in Brazil or Australia, where I think this advance does look like a 5-wave from the bottom that we made in March. And then sorry, this is Canada. So this looks very much like the US. Canada would tend to track, very much US, but this is Australia. I'm trying to look for the next impulse to actually, start in Australia. But what we have here is 1, 2, 3, 4 and a 5, and then an ABC kind of a correction. So ideally, this should be start of another 1, 2, 3 structures. So 1, 2 and 3. Once you start getting that, then we are sort of clear as far as Australia is concerned. In fact, visually, it looks like maybe this is also a 61%. Yes, it is a 61% retracement in what should be a wave 2. So long consolidation phase back here also for Australia. It tried to rally here as the dollar fell. It's pulled back recently and should be sort of trying to start a third wave. So third wave meaning that if this is the first of the structure, this one, and the third is 1, 2, and then start 3, very, very much like what the EM index itself is doing. So across emerging markets, just like in Nifty, we are seeing a steady recovery. Each of them may be in different phases or stages of that recovery, but they're sort of going higher. So that is I think the trend. All the fear that we get right now, and this is what I keep saying in my podcast, comes around from global, specifically US markets. And so what you really want to do is go and look at what something like the S&P 500 is doing, or the index that all the hedge funds like to short, which is the Russell 2000. So if I simply do a good quick cross section of US indices, the S&P 500 daily RMI is it's gone buy, sell. It's sort of whipsawed on the daily chart, but it's again trading above the 20 days. So if you notice this entire period, it's actually not breaking the 20-day average. It's trading above it, which is very interesting. From this low, it's gone up and then it's just staying up here, waiting for the momentum to kick up, in my mind, to start making a higher high. And on the other hand, if we actually go and look at the Nasdaq composite, we may get a similar picture, and then I look at the Russell, because those who are bearish essentially looking at. So when we look at the Nasdaq composite, that's the one which is stronger because the FANG stocks continue to make new highs. The Nasdaq did make a higher high through this period. Somewhere I would think it's trying to do a 1, 2, 3. Okay, which means that this initial rally here is 1, 2, and then it's doing a 3 or starting. Now, if this is an overlapping 5 something, it can pull back and go up also. Not ruling that out, but the daily RMI here has turned bullish, which actually indicates that probably the rally should move forward. And on a slightly larger scale, from the bottom that we made in December, which is where I think the Nasdaq bottomed, unlike the S&P which bottomed in October, the Nasdaq made one more low here, and from here it's actually 1, 2 or AB, whatever you say, and then the third wave is another 1, 2 and 3 starting. So you need a 3, 4, 5 before you can even say ABC is complete, or else if it's 1, 2, 3, 4, 5, then there's a fourth and a fifth, right? So a lot more to go, and the main thing to watch out for is what will happen on the monthly scale, because even weekly charts are bullish on the RMI. Okay, so the buy signal is intact, no whipsaws. Even here it looks like, but it didn't break to the sell side. Held the 20-week average and it's continuing. What you really want to, as a final confirmation that the bear market's over and people are still hearing a lot of negative news around US, is crossing the 20-month average, which is at 12,594 for the Nasdaq composite. So once you get past that, we would actually start anticipating that worst is over, because the previous two bear markets, once they had gotten back above these averages, like here, that was sort of meant that the bear market was done. Till that point, it didn't happen. Every rally led to resistance at these averages, and then the market fell further. So we are at that point. We are very close to this level, and you want to see whether we close above it. Let's see if that happens in the month of May. Another 14 calendar days to go. And by that time we'll figure it out. But the momentum indicators are positive, daily, weekly, both indicating that the Nasdaq does make higher highs, which is why I think that is going to be the outcome. And that's the outcome with which I'm working. The last is the weakest spot in the US market is actually the Russell. Okay, and the Russell 2000 overnight, it's been trying to hit the lows again and again. And what I'm sensing though, and I've drawn a couple of trend lines here, is that it's actually making multiple bottoms around this range, not really breaking down. So which range is that? That's around 1710. So near 1710 bottomed here fell slightly below it for one day intraday, again bottomed, third time it has reached this level. And the RMI is actually turned positive. So last couple of days, even as it's consolidating below the averages, the RMI remains in buy mode. And so it's a tricky setup, because what if it falls? It can go into sell and you're still below the 40-day average. Give it another day or so. My sense is it will break to the upside once all this negativity is priced in. I think next week you're going to get the talks on the debt ceiling finally, I hope, because they postponed it from this week to the next week, and based on how those talks go through, will have a direct impact on some of these sectors. This has been the sector which has shown weaker earnings for this quarter, which is probably can be used as an explanation as to why it has underperformed. But this is where people are beating up this index also. Everybody shorting or suggesting you short this in the US versus being long bonds, and that's the hedge fund positioning. But if I look at the Russell's RMI, it says buy, and if you look at the momentum, it looks like waning on the downside, not breaking that 1710 range. And if it doesn't, and if we manage to recover, the weekly RMI of course will take time to cross over. But if we do get that bullish crossover in these two, then the weakest part of the market would have bottomed and would start joining the rally on the upside. So do watch out for that, because the daily is already giving some indication that can happen. And we are making multiple bottoms around this support range. So I think that sort of gives you a broad insight of what global markets are doing. Against all odds, they are showing some positive skew. I've already discussed because of the short positioning in my YouTube shorts, and that in the US is really continuing to remain. Everybody's just shorting every rise because the news is so negative that they end up anticipating something would possibly go terribly wrong. But price action across US or specifically Asia, emerging markets, is not indicating that kind of a trend. And we're actually seeing strength in most of the Indian indices. In fact, the good news is bond yields are falling. Yesterday, I think this week we saw CPI data, continuing to drop. And what you really want to watch out for is WPI this month. Some people are predicting that the May number, which will only come out, after the month is over, might actually drop to negative, because WPI has actually been falling much harder. And that sort of gives you the trend and direction. The WPI and CPI will never match. But usually if one is falling, the other is also falling. That is what I have seen, because the data points, many of the data points are common, even though there are some differences. So negative print on the WPI would also mean that you're going to see a sharp reduction in the Indian CPI. And the bond market is smelling that out. The rupee, not yet. So bond yields in India continue to drop even today. Right now, as I'm recording, it's below 7% now. It's at 6.979, the 10-year GSEC bond yield. And that I think is very supportive of the market. What you're still not getting on the upside here is the currency. The USD INR has still not started to weaken. Why that is can be a big question mark, because we anyway have lagged the dollar index, right? The dollar index did peak, in October, September of last year and has fallen from there. The USD INR has not. So despite this weakness in the dollar, it's not really ended up reflecting on the rupee itself. That is a interesting fact, and will remain something as a maybe botheration to some extent. But these things can diverge. We don't always get correlations between 90% of the time. Yes, USD INR and Nifty are inversely correlated, but couple of short occasions we've seen where the two just break away. So far this looks like one of those moments, because the USD INR has gone up for the last 5-6 days, and the Nifty has also been edging higher, and so there's some breakaway. We'll see how the end result comes out, because till we really break out of this triangular range, we can't say whether the triangle is bullish or bearish. I have both waveforms open right now for the bullish and bearish case. We also add 61% retracement of this previous fall. So till we really see it break past that, we can even argue that this is just a peak and then we go down again. Or if we go past that, we'll test this line, and only above that can we say we have a bullish breakout. So still got a couple of testing points, and I don't know if we can really break away that far against the idea that the DXY or the dollar index has peaked as it did in October of last year, and everything is only a retracement. So then why is our currency pair holding out so strongly? Question mark, no answer yet. And so I'll just leave it at that. The bond sometimes, yeah, one thing I can indicate to you though is that whenever bond yields fall, okay, which is in a way weakening your currency, right? Even though we may not be cutting interest rates yet, but if the bond market, whenever it signals lower rates, it does put upward pressure on the USD INR. So even it may not be going up, it may not go down that fast. It's only when the yields will pause somewhat is where the currency may actually make its dip. So there's some kind of an inverse relationship between these two, which you can actually see when you move to a slightly larger historical chart, right? So if you actually see this phase here, I think this is now something new that I'm showing, which some people may not have thought about, is when here bond yields are falling, the USD INR is actually on the way up, and here when yields are rising, then it's sort of flattish. So it doesn't always mean down, but it can mean down or flat, some kind of downward pressure. The extent is, of course, requires your understanding of the wave structure at that point of time. And so right now, falling bond yields have kept the currency weak to flat. So even if the dollar weakens, the USD INR should head down. But at a time when bond yields are falling, will it happen simultaneously is a question mark. So there could be a lead lag between both of these markets, even though they both form triangles. That's what I found interesting. So I thought both would break down together, but that inverse relationship is probably working its way at keeping the currency from breaking down. So this is the last part of my update for today. Like I said, to continue to get the Nifty intraday wave count updates, do subscribe to Indiacharts Insiders. We do it every day on the app, and many more updates than that across all these markets that we are discussing here, through daily posts on each of them. So then you remain updated about what is really happening, and don't miss the weekend with Indiacharts. That's where I have this very detailed discussion across these macro factors and try to stay on top of what the unfolding trend is. So with that, Strike, the software, the new analytical product that we are really launching, should be out maybe a week to 10 days. So do look forward to that, and you're really going to enjoy it. I think it'll be one of the best things that we've probably done, and best products that you would have seen. You wouldn't have seen anything like it, is what I can say. You've probably barely seen 5% of it in this video discussion. So you can imagine what else and what more we've really put inside it. So till the next update, thank you.